Yeah, welcome. Hi everyone. Hi everyone. I actually have been bothered because many people have been dropping comments from me on my comment section that they have been taken off always by the market makers using stop hunt. The stop hunt has been looking out for them, and it's as if it is impossible for them to make profit again. So I have come up with this brief video in order for you to be able to learn how to understand this manipulation and stop on from the institutional traders and from the market makers, so that you stay ahead of the market. So I want to show you how you can beat the market manipulation and stay ahead of the market. So guys, watch this video to the end, because I'll be teaching you at the end of it. I'll be teaching you some key things that I use personally in order for me to beat the manipulation in the market. But first of all, I want us to understand something before I move further. Now, the market makers and the institution, they always want to make the retail traders to be their liquidity. They always want to make the retail traders to be their liquidity. And for you not to be their liquidity, you must learn how they trade and how they manipulate the market, so that you can stay ahead of the market. Now, what they do is that they cause retail traders to be stopped out of the market, even though the direction of the retail traders is actually correct, is actually perfect, but they act as if it is a wrong direction, and then make them to become their liquidity. How? Institutional traders always want to make profit. In fact, everybody in the forex market want to make profit, but it is our wisdom and understanding of the market that makes us to stay ahead of the market. Now, I want us to understand something, that market does not just move in a straight line. Market move in a zigzag. You can imagine, you can see what is happening here. It moves in a zigzag manner. Look at it. You see, from here you see up, down, and then it's moving in a rangy market. So you see, going up, down. So it moves in a zigzag manner, and because of this, there are three common manipulation traps that the market makers put in place, so that they can actually trap the retail traders and get profit from their trade. Now guys, before we move further, if you have not subscribed to this channel, use this opportunity to subscribe, so that you will not miss out in any of the videos that I'll be releasing. In fact, I've made up my mind to teach until my community understand forex as I understand. That is now my idea. I want by the end of 2025, at least 80% of my community members will be able to trade forex the same way that I am trading. So use this opportunity for you to learn it in a perfect way, and also from an experienced trader. Now, there are three common manipulations. So guys, go ahead, subscribe, and then click the notification bell, so you'll be notified whenever we upload videos such as this. And don't forget to give me comments, let me know how this video have actually helped you in your trading career. Now, the first common manipulation and traps that the market makers or institution give onto the retail traders is the stop hunt. The first manipulation is the stop hunt. Now, I want us to understand what the stop hunt is briefly. Now, stop hunt mostly happen around support and resistance level. Now, let's look at this. Now, the market, you see the price coming down here, forming a support. And our common sense will tell us that this will actually go forward a reversal, that's for a buy. Before we saw that they gave this particular stop point here, and then there was a sell. And look at what happened here again. It forms, look at what happened here. It forms a support here, and then the market makers drive this price upward again, giving another stop point, breaking the resistance at this particular place, because stop point has to do with resistance and support. Stop point is always given at the level of resistance and support. When price hit and break against the support or resistance and then reverse back again to continue moving the right way, is stop point. That is what, that is stop point. And we mostly see it at our area of support and resistance. Now I was given an example here. Look at what happened here. Here is actually what, a support. Here is a support. Look at what happened. So price broke here. Now price broke here, this area of support. Now you would think that there is going to be a change of trend, but all of a sudden it returns back. Now if a trader now at this point entered a buy, definitely is going to be stopped out, definitely. And if the trader at this place enter a sell, when he starts seeing this now and he puts stop loss, definitely the market makers will hit the stop loss and then make profit from him before returning back. So this is usually what happens with the market makers. They always want to give onto or stop on before a quick reversal in the market. You see, after a stop on here, there was a quick reversal. You see, very quick reversal in the market. So that's the first thing, and we need to understand. Now their concern is for them to take profit from the retail traders. Like I said, take profit. So you need to be careful in the stop on, so that when you see a stop on, you will be able to identify it. In fact, I did a video on stop on, so you can check the channel, my channel, and you see I did a video, comprehensive video on stop on, and you will love that video so much. You will love that video. Now let's move on to the second common manipulation trap. The second manipulation trap. Now look at another stop point here. Look at another stop point here. This particular place and this particular place, they are stop point, because this is the previous word support, and this was the support that it was given before the stop point. Now the second is false breakout. Now price break key levels within initial strong volume, loading to fear of retail traders, leading to fear of retail traders from losing out. That's the fear of losing out, and then we see a quick move, a quick reversal in the market. Now let's look at key areas. Look at key areas. Like here, there is a key area. Here is a key area from the previous place. Is a key area. So look at what happened here. Look at what happened here. You see what I'm talking about? These are key areas, because if you notice, price from here respected this area here, respected this area here, and still came again to respect this area at this particular place. Now what is the breakout now? What is the breakout? Now when we see price at this particular place, we expected the price to reverse immediately. We expect it to reverse immediately, because this is a key area, but there was nothing like that. In fact, we saw a quick move. Look at this candlestick here. there was a quick move downward. This candlestick is actually a quick move forward downward. It proves to us that this is a what? A false breakout. Now how do I say false breakout? Now look at this particular place. It broke up here. There was a breakout up here, and then before you know it, it was broke down, returned, and it broke down. That is what we call false breakout. In fact, look at what happened here. Even this is actually a false breakout, because after this breaking down here, it was returned back to the trend. You get it? So that is key levels. When you look at the key levels and then it refuses to respect it, and then here comes a face breakout in the level again, it is actually a manipulation in the market. Let me look at another example so that we'll understand. Let me look at another example. Okay, this one is BTC. There is no example here. Let me see an example. Now let me get an example. Okay, look at here, this key area. No one disturbance, that's why I'm offering a distance. Now look at this key area. Oh no. Look at this key area. Now look at what happened here. This was a key area. It came down as if it was to sell, and no, it gave a false breakout upward here. You see it, and then quickly it returned back. A very good example. And then came back again and tested it before it started going what for a sell. So look out for this false breakout. This false breakout. This is actually a trap, manipulation of the institutional traders against the retail traders. The market makers always against the retail traders. Now look out for this manipulation. This is a false breakout. Then the third thing that I want to share with us, common mistake or common manipulation trap, is the liquidity swept. Now I've done a teaching on liquidity swept. You can check the channel, you see it there. But meanwhile, let me explain this to us. Now what is liquidity swept? Liquidity swept is when aggressive price pushes into wide wanted area. When price aggressively pushes into what? Widely watch area, and it can be wanted area. Why? Because people are putting their eyes there. In fact, those are institutional levels. Those are what? Institutional level. Now we are talking about previous high and low. When I'm talking about institutional levels, people always look at previous high and what and low in order for them to trade. Now at that particular point, now it can also serve as what? Serve as a manipulation, like what happened here. Okay, sorry, it was the BTC, because people were looking at that particular particular level. The BTC is downward. Let me go to it. You discover people were actually looking down on it, on the level. People were looking at this level. Look at it at this level. People were looking at this level before there was what? A stop hunt. So you see, this is institutional level. So liquidity swept is when this particular level goes with what? Goes with an aggressive what? Push of price. against the high and the low of the day. So now most at times people focus on the high and the low of the day in order for them to trade. High and low of the day is very important, but those areas can also be manipulated by the institution or the market makers. Put that at the back of your mind so that we can be able to go. Now what they do is for them to collect the orders, and then immediately they have collected the orders of retail traders, there will be what? There will be a quick reversal in the market. Now to spot this, you need to use divergence, and that divergence must be from the 15 minutes time frame, 1 hour time frame, and then the daily hours time frame. You need those time frames for you to spot a very good strong divergence that will actually stand against liquidity sweeps, because that is one of the secret of what I'm sharing with us. You need to understand divergence. Now, so having said this, like I said, watch this video to the end. Don't skip any part of this video. Learn this video, learn, and you will thank me in the comment section. I know what I'm teaching you. You will thank me in the comment section. Now then, the major thing now is, how do we beat this market manipulation? How do we beat this market manipulation? Now the first thing is that you need to stack confluences. What is confluences? Confluences are agreement of different strategies and should I say patterns that permit you to trade. Now such as support and resistance level, price action. We talk about confirmation with technical indicators, etc., etc. Now you can use that. Now let me just go through some of them that can help us. Now you need to stack confluences. At least you should have not less than 2-3 confluences that support a trade, so that you will stand against the manipulation of the institution in the market. Now the first is the support and level and resistance level. Now for you to trade, make sure you confirm if there is actually a level of support and resistance. Like if I want to trade now, this is actually what my support, and then the resistance can be anywhere up here, can be anywhere up here, can be anywhere up here. Now this is the first thing that you need to look out for: level of support and resistance. You need to draw your level of support and resistance. Now you need to draw it. I advise people to learn how to draw it. You see it. This is how to draw it. You need to what? You need to learn how to draw it. Use your horizontal box and draw your area of support and resistance. Draw it is very important. Learn how to draw it. Very, very powerful. Now, once you have done this, you have drawn it, the next you look out for is you need to observe price reaction. When I'm talking about price reaction, I'm talking about your chart patterns. Is it a continuation chart patterns you are seeing, or a reversal chart pattern? Now I'm talking about double top, double bottom, peg net and wedge, etc., etc. Now you need to look at this so that you will confirm if it is actually going to go up, or it's going to go down by your by your chart patterns, either it is continuation or reversal chart patterns. Then the next one, you need to confirm the signal with an indicator. We have many indicators that we confirm signal with, either the crossing of the 30-moving average with the 50-moving average, or the 50-moving average with the 200-moving average. So there should be confirmation. And then use the RSI also. Use the RSI to confirm divergence. Very important. Now use the RSI. You see, I always use my RSI. Use the RSI to confirm divergence. After that, you have used the RSI to confirm your divergence. You see, like here, for example, look at what happened here. Look at what happened here. You can see here. Yeah, price is what is up. Price is up. Look at here again, here and here, and then here and here, and here and here. You are seeing what? You are seeing hidden divergence. Now this is hidden divergence, and what happened? There was a sell. Now you need to understand this divergence. I also did a video on divergence, so this is a very good divergence. You can actually watch and then learn. This is actually a very good divergence. It will help you a lot. So you need to understand divergence using the RSI moving average. And then the next you need to understand is your Fibonacci retracement. Fibonacci retracement. Now you touch here, come to your Fibonacci. This is Fibonacci. You need to check your Fibonacci retracement. Now this is the Fibonacci retracement. So you need to understand how this Fibonacci work, especially using the zones, the 61 zone, the 50 zone, 38 zone, and 23 zone. So you need to understand and use them in order for you to get more confidence in the market, so that you not enter and get trapped in the market. Now if you use this Fibonacci well, it will help you in order for you to shade off false movement and traps in the market. All this stop hunt, you won't be able to fall trap of it if you use your Fibonacci retracement level. You will understand that this is actually a trap that the institutional traders or market makers are trying to give the retail traders. So with this now, you'll be able to understand that is one aspect of the confluence. That's stack your confluence, have many confirmations. So the next one is that you need to position yourself to ride with the institutional wave. That means you need to follow the trend. Watch the market. You need to trade what you see and not what you assume. Don't be the liquidity that the market makers are actually looking for, but ride with the market makers so that you tell them that you are also smart. So you need to trade what you see and not what you assume. Please put at the back of your mind, we trade what we see, not what we assume. We trade what we see, so that if you are seeing it is going for a buy, even though the overall trend is actually a sell, it means that you need to wait, because the buy will not last for a long time, and then there will be a reversal. So put this at the back of your mind, and I know and I'm convinced that you will be able to trade well and make profit. So thank you so much for watching this video. Do well to watch the next video, and don't forget to share this video with your family and friends. Thank you so much. See you in the next video. Thank you for watching this video. Do like, share, comment, and subscribe to this channel for more information.